Thanks, Mike. As you mentioned, I work for Mercy Corps. I lead our global portfolio on financial services in crisis situations, as well as our financial services work specifically linked to displaced populations. For those of you that don't know Mercy Corps, we're a development agency working across 42 countries globally, including 16 countries in Africa. And we have a strong commitment to working in complex crises, which includes acute conflicts, protracted crises, natural disasters, and economic and political crises. Today, we're responding to some of the world's worst crises, including in Afghanistan, Lake Chad in West Africa, Somalia, South Sudan, and Syria. From a financial perspective, Mercer really tries to work at the nexus of humanitarian response and economic coping and recovery with an eye to entry points for longer term financial inclusion. Over the past year, we've worked in partnership with Financial Sector Deepening Africa to help them develop their research agenda and plan for financial sector development in fragility affected regions in Africa. The result has been a think piece where we helped answer three different sets of questions. So, one is, what do we mean by fragile? The second question really looked at what makes financial sector development in fragile areas and protracted crisis distinctive versus non-fragile areas. And three, what are promising practice for development actors? So looking at both donors and market facilitators, and what should we be focusing on in financial markets moving forward? So for the first question, what do we mean by fragile? We relied quite a bit on DFID's definition as well as on the OECD States of Fragility Report, which is where the visual is from, which really looks at violence, resilience, economic foundations, institutions, and justice. So I think the main thing that we found is fragility is very context specific, and it can include very different stages of conflict, meaning rapid onset, latent, cross-border, and in between stages of conflict. And another thing we found, which I think most of us know and see in our day-to-day work, is conflict really does not follow clean patterns. There's not, in many of the places we work today, there's not necessarily a post-conflict state. Rather, it's a protracted and reoccurring with no clear pre-crisis and no clear post-conflict. One thing that we did find too is that in fragile states, there are some very common characteristics, including poor governance, weak capacity in institutions, high risk of conflict and insecurity, poverty, and high potential for distortion by humanitarian aid. So what's distinctive? What's distinctive in fragile regions and those that are in protracted crisis? So again, financial markets are very context specific. However, we did find some overall common themes from a financial services perspective, especially for those in higher fragile contexts. So one is the private sector definitely remains functional through crisis, especially in active conflict, transactions become much more informal. There's higher transaction costs, very unpredictable political context, high mobility of populations with recurrent humanitarian needs, market failure, weak institutions, non-diversified economies with focus on one commodity or one sector, and quite a bit of insecurity, infrastructure challenges, as well as a reliance on informal financial mechanisms, meaning families, households, and businesses were having to rely on family and friends, informal savings group, money lenders, or just saving under the mattress. From the demand side, we found some common consumer behaviors, again, specifically in fragile states, is that both households and businesses tended to be more risk adverse and tend to invest less. If they did invest, they chose low risk activities with low return. Very low experience with formal financial products and services. Higher rate of mobile money usage actually in several countries. And there is a high demand for credit, but often for medical emergency or for consumption needs. We also found, especially in active conflict and for displaced populations, the demand is often for financial services to help stretch incomes. Whereas in more latent conflict, financial services, especially credit, was looking to help sustain or diversify incomes. From the supply side, so challenges for different financial services providers operating in more fragile states, we were able to find a representative examples, specifically pulling from South Sudan and some examples from Guinea-Bissau. Both have had market collapses due to ongoing conflicts, and both face with underdeveloped financial sector and extremely low banking penetration rates. So a couple of things that we found is that there's few banks, very limiting financial alternatives, meaning very limited, if any, leasing, insurance. NGOs tend to dominate the microfinance sector, but tend to have limited capital and very limited sustainability to scale. Formal finance tends to vanish during active conflict. Um, and when the active conflict potentially subsides, there tends to be short-term credit available, but nothing for any long-term investments. We actually found banks typically tend to be liquid due to lack of these investments and low competition. Very high cost of doing business for financial service providers in the sense of high electricity prices, um, but also a small market size, preventing any type of economy of sale, as well as low efficiency of contractual agreements, um, which can make it very difficult for financial institutions to want to actually do any type of long-term investments. There's also very limited space for new financial actors to enter the market, which can be very limited to innovation in types of providers as well as in products. So those are some of the challenges that we found. Well, challenges I would say, and also realities that we found. But one of the things that we did find is looking at the next steps in the think piece was to think about how knowing these are the challenges, how do we move forward with a more market systems approach? And one of the reasons that we use this approach, which is the reasons as well that the financial sector deepening Africa uses these approaches, is that we recognize that market systems development is highly dynamic. So because it can be actually very appropriate in a fragile region, as it acknowledges the unpredictability in markets. And two, the market systems approach is very context specific, prioritizing scale and sustainability. The visual here actually demonstrates a market system in a fully functional financial market. So it includes, for example, telecommunications, wholesale capital, um, from supporting functions as well as financial institution frameworks, different types of credit rating service, as well as the various rules. But as mentioned before, we don't tend to often find these especially in very highly fragile states or in active conflict. So one of the main things that we found with the market systems approach, especially in a fragile state, is that the financial sector is often a supporting sector of other market systems, meaning that it's actually required to be in place first for the development or growth of other market systems. So, for example, for the agriculture sector, for the health sector, for energy, construction, education systems to grow, there needs to be a strong or at least a growing or strengthened financial sector. So really, the financial sector definitely needs to be prioritized in any type of conflict situation, especially in any type of fragile state. Again, recognizing that the supporting functions may be very limited, or there may be mismatched functions. We also found often that the market facilitator, at least at the beginning, needs to play a much more active role than we would in a non-fragile state. Looking at the regulatory environment, there's often a higher systemic risk, often very limited consumer recourse as well, which can be a barrier for customers to want to engage with the formal market. So what's next? We found various promising practice for both for market facilitators and for donors in fragile states and in protracted crises. So from a foundation perspective, we looked at different regulatory approaches, which includes as well as ID solutions. For market segments, the need to prioritize refugees and other forcibly displaced populations, as well as Islamic finance, different types of financial products and instruments, prioritize inclusive insurance, as well as liquidity and partial credit guarantees, as well as opportunity to explore and expand on different diaspora investment platforms. And fourth, looking at different financial delivery channels, including impact investing, including blended finance models, as well as the need to invest in payments and remittances infrastructure. So I'll go into a little bit of detail on a few of these. So for adapted regulatory approaches, the need for tiered know your customer was consistent throughout the countries we looked at. The need for functional ID, consumer recourse, collateral alternatives, and the need for mobile money and remittances and agent banking. These were all critical and need to be really part of any type of regulatory approach or any type of financial sector strengthening within a fragile area. Looking at delivery channels, the need to prioritize remittances. We found remittances right now are the largest aggregate flow to fragile states, over 90 billion. And in Africa, Africa's diaspora consists of 30 million adults, which sends around 40
Conference will
billion
automatically end in
back.
5 minutes.
From a client perspective, again, the need to prioritize refugee and displaced populations, which Joe from Financial Sector Deepening Africa will go into a bit more detail. But I think the important thing that we found is really recognizing that for displaced populations, they have different financial needs at different stages of displacement. And also looking at different market segments is Islamic, the need for increased Islamic and ethical finance. Right now, Islamic finance has a formal and growing presence in 21 African countries. So there's a need for standalone financial institutions and windows within existing financial institutions, as well as opportunities within different leasing products. So some of the top line recommendations that we found, which you can find much more detail on in the think piece, is the need for increased use of blended finance structures to help promote private sector engagement, to really help buy down the risk of for the private sector players. This can include both impact investors and social enterprises. It's really important to engage early within conflict situations or in crisis situations to build partnerships and gather market information for private sector entry points. Third, it's important to carefully sequence interventions, ensuring constant diagnosis and feedback loops. So programming could take advantage of windows of opportunity, including new products, actors, and market segments, as well as doing continuous do no harm and conflict analysis. 4, it's important to actually build on what we already know, what works in financial services. So understanding liquidity, consumer preferences, push versus pull products, and the key to market segmentation. The difference is we seem to sometimes adapt our tactics in a fragile area. So moving forward, from Mercy Corps, we have 2 sets of upcoming research for conflict and protracted crisis settings. One is in Northeast Nigeria, where we're looking at livelihoods and market recovery in 3 conflict-affected states, specifically looking at constraints to market systems in the agriculture sector, but looking to understand leverage points, including financial services for host communities, IDPs, and returnees. And in Syria, we're also leading a coping in complex crises study at the moment, which should be ready this fall, which takes a look at economic and market factors, and especially looks at the roles of markets, financial services, and remittances. And those will be available, both of those this fall. So thank you so much. And next is my colleague, Joe Huxley, who's going to talk a bit about the work that Financial Sector Deepening Africa is doing with displaced populations.